Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome back to the show where we interview the nation's leading real estate entrepreneurs. It's your host, Stephen Schmidt, and I'm back again with yet another treat for you guys. If you're joining us for the second, third, or 100th time, welcome back. You know you're going to get some value out of the show today, as I always deliver for you. And if it's your first time, well, you better get ready to add this to your regularly listening schedule of podcasts. I got Erica Neal in the house today, and Erica has an incredible professional background in the finance and economic space. She's gone all the way from having a large investment firm. She's an authorized IBC, otherwise referred to as the infinite banking concept practitioner. And she educates investors and business owners on how infinite banking can actually improve their liquidity, boost returns, lower taxes, and protect assets, which is what we all want as investors. We want to protect our assets, lower our liabilities. So we're going to go all over the place today. But before we get started in some meat and potatoes for the episode, just remember at Investor Fuel, we help real estate investors, service providers, and real estate entrepreneurs 2 to 5x their businesses, which allows them to build the businesses they've always wanted in order to live the lives they've always dreamed of. Now, with that being said, Erica, welcome to the show today.
Thanks, Stephen. I'm happy to be here.
You bet. So you've got a 12-year background in all this fancy stuff, all the numbers. Give us a little bit of how you got started, like back in the day. What made you decide to pursue your degree in finance and economics and work for a large investment firm? And then what made you kind of pivot off from there and get where you're at today?
Yeah, absolutely. So I grew up very, low SES. We didn't have any money. I remember like sitting on the kitchen floor, cutting up coupons with my sister, thinking, oh, maybe we can get pizza tonight kind of thing. So when
Did you just say low SES? I don't mean to interrupt you, but that is like the richest way to possibly say I grew up poor that I've ever heard in my life. That's amazing. I grew up. I'm going to start saying that.
To be like PC about that. I was poor. I was real poor. Yeah.
I've never heard that before. That is awesome.
So funny.
I love
Thanks
that.
for calling me out on that, Stephen. I know.
I'm sorry. The internet's going to shred me alive now. Okay, go ahead. Continue.
Either you or me, we're both going to be on the chopping block for that. One of us is really going to eat it. Oh my gosh. But yeah, it's just, it was my mom. She worked super hard. And I grew up in West Texas, so it was just like you work hard, you get, dirt and oil on your hands, and that was just what you did, which is great. And there's so much value to that. But when I went to college, I actually started off pre-med, but when I ended up became a teenage mom, 10 years of medical school was off the table. Yeah, and I was like, well, that's not going to work out. So when I was transitioning out of the pre-med space, I was talking to a counselor and looking at what did I want to focus on. And I thought, I've never had money. I'd like to, and I should probably understand it. And so that's where I started focusing on finance, double majored in finance and economics because I was just fascinated with this idea of
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
What is money? How does it work? And how can I get some of it? So that's what got me into the finance world. And then, of course, when I graduated, I was looking for a job in finance and got hired by a large investment firm out in the Fort Worth area. So that took me from West Texas out to Fort Worth. Worked there for several years, and I learned a lot, met a lot of great people there. But what I realized is that Wall Street is very focused on teaching people how to put money into an account and get a good rate of return, which are great things, right? Those are good things that we all want. However, there's a disconnect with actually teaching people how to put their money to work for them, how to generate cash flow, how to get income. We all know how to put money into an account, but we don't know really, a lot of people don't know how to start making that money work for them. I saw a lot of people in that space in their retirement years just running out of money, just flat out, it dried up, the well dried up. So realized I didn't want to do that for the rest of my life. Ended up branching off of that. I got connected with a boutique, smaller independent firm in Fort Worth, and they actually focused on cash flow and income strategies, and they were independent brokers. So it was something where instead of being captive with just one company where, you work for company A, you sell company A products, this was an independent firm. So we had multiple A-rated companies we could partner with. And so that was a really, really valuable learning curve. It was a vertical learning curve, but learning curve nonetheless. So when I started with them focusing on cash flow, it was a unique experience that the main owner advisor guy was not just doing traditional financial advisory, but he owned businesses. He was investing in real estate. And I was like, oh my gosh, most people are like, Wall Street or bust. You have to put all your money into the stock market. And so I started to learn from him, went into a couple of real estate deals with him. And I also was introduced to the infinite banking concept as a way for storing cash, which was really interesting to me as a young person. Not having all my money locked up until I was 59 and a half or 60 years old was enticing. So
Sure.
When I got introduced to the infinite banking concept and real estate, started using that in my own personal life, there was another guy, David White, in the office doing the same thing. We ended up partnering up and working with some other real estate investors and teaching infinite banking, learning real estate, kind of a mutual benefit there. And that area of our business and our joint work that we were doing really took off. And we ended up deciding, hey, we need to branch off, launch our own firm, which we did. So we co-launched Infinity Investment Strategies, and that is now our firm where we are infinite banking practitioners that specialize in understanding and working with real estate investors and business owners, and being real estate investors and business owners ourselves, and teaching people how to create these cash flow strategies with the infinite banking concept. So it kind of went from one end of the spectrum all the way to the other.
So, Erica, for somebody that isn't aware of what the infinite banking concept is, what is it?
Yeah, good question. So infinite banking is, instead of keeping your money inside of like a self-directed IRA or a traditional bank, the whole concept is, well, what's a bank going to do with your money? A bank is, you deposit money in there, they're going to loan it out to somebody else, pay you very little, and go earn a lot more. They're creating arbitrage, right? Earning more than what they're paying. So you can become the bank yourself and create your own privatized bank. And we use specially designed cash value life insurance policies where we focus on the cash value, not the death benefit. So there's a whole IRS tax code. So if you really want to nerd out, it's tax code 7702. But we focus on maximizing the amount of cash that you can put into these policies, and you get all the benefits of, there's tax benefits, asset protection, right? You get all the benefits of life insurance, but you have access to the cash value inside of these policies. So you're becoming your bank, keeping your your cash inside of one of these policies instead of a traditional bank.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
And you're going to recreate the banking system to your benefit instead of theirs. Meaning, if you have a real estate deal, I'm going to use easy numbers, for example. Let's say you save up $100,000 inside of your policy and you have a real estate deal come up. You want to take out $70,000 to go invest in this deal. Now, if you go take that from your IRA or your bank account, if you have 100,000, you take out 70, you go get your rate of return, and then you're only earning interest on the 30,000 left over, right? Pretty cut and dry. If you've become your own banker, though, you create the arbitrage strategy with loaning. So you are going to borrow against that cash value. You're going to borrow that 70,000. You do pay interest on that 70. However, you're going out and you're earning more interest than what you're paying, which sounds familiar, right? That's what banks do. In addition to that, while you're out there earning a rate of return with your $70,000 investment, you're still earning compound interest and dividends on the full $100,000 cash value. So you're able to do what Robert Kiyosaki says and give $1 multiple jobs, right? Creating dual rates of return. But like I mentioned before, there's all the tax benefits, asset protection. You have control over that. And the one thing I will add to that is when you're borrowing out that policy, a lot of people are like, oh, well, if you say the word loan, people think I have to pay that back. The good news is you're the banker and the borrower, which means that you are in control. So I'm in a few deals right now that actually pause distributions for a couple of years. So if I've borrowed against my policy to go invest, but I'm not getting distributions, the good news is I make the rules. So I don't have to pay back my policy loan if I don't want to, or if it doesn't make sense in that time period. So there's a lot of strategies behind how this correlates so well with real estate, gives you additional returns, gives you additional tax benefits and asset protection. But I think the main thing that a lot of us want in this entrepreneurial space, control. We want control. And that's another element that the strategy provides.
100%. Well, Erica, how does that exactly work? I go and I get an insurance policy, and how do I save money in an insurance policy? That doesn't make no sense. I thought insurance is for when I die, right? So just for some background too, I'm actually, I have my insurance license, very familiar with this. But that's the question I get all the time. It's like, well, how does that work? You know what I mean? So that was an incredibly simplified, high-level overview of exactly how it works.
Yes.
It's probably one of the best explanations I've ever heard anybody give on it, to be honest with you. But for that person that's like, well, how does that actually work? Can you give us a little bit more insight and kind of dumb it down for, the guys like me that might not be as book smart?
Yeah. So I think I use a lot of analogies, and I like to use real estate as an example because I think most of us are familiar with real estate. So it's a good way to create some parallel. When you buy an asset, right? Let's think of a house or a property. There's the value of that property. But when you buy a property, you are going to build, even though it has a value, you're going to build up equity within that asset over time. Now, I'm just going to use a house, for example. If you buy a house and you pay just the mortgage, you're going to build equity up over time, but it takes a while to do that, right? So with these policies, that's kind of the same way. You buy this asset, it has a value, which is the quote death benefit. Now, I'll tell you, some people want death benefit, some people don't. We can customize that for each person, but the point is there is a value to that asset. Every single time that you pay for this policy through your premium, more and more and more of that is going to the cash value. Now, it happens much faster than an amortization schedule, but it is, going towards going to the value of the asset, but you're building up equity over time. Now, coming back to the house example, you can pay over and above your mortgage, right? And apply that directly to principal, apply that directly to equity to build up equity faster if you want to. You're not obligated, but you can. The same thing applies with these policies. you can put extra cash over and above your premium.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
That goes directly to your cash value, that goes directly to earning guaranteed interest and dividends. And so that's the way that when we're working with people, we focus on how do we get your cost as low as possible and get as much cash as we can in there to build up that equity as fast as possible. And I want to emphasize, because people are like, oh, well, I still have to pay for the life insurance policy. I can tell you right now, I have 4 policies in total now, but all of my policies are to the point where I'm not even putting any extra cash in. I've maxed it out, which we can talk about later. I'm not putting in any extra cash on 2 of them in particular. I've maxed them out. Even though I'm only paying the base premium, my cash value is going up more than what my premium is. So that's the way these policies work. Once you overcome, just like real estate, there's an acquisition cost. So once you overcome the first couple of years, you start to get what we call the multiplier. So if you put $1 into your policy, you're going to get out not just $1, you'll get out $1.10, $1.20, $1.50, $2, because all of this strategy is predicated on the compound interest curve, which, what does compound interest do? Starts off here and then it takes off exponentially. So when you allow, exactly, it shoots up more and more. So when you allow the cash and the money inside of this policy to compound, even when you stop putting extra cash into it, if you only pay your base premium, you're going to be getting a multiplier on that money. And let me ask, like, if you put $10,000 into something and it grows by 15, how much did it cost you that year? Right? It's not a cost. So when we're talking about designing the policies, our job is we're going to figure out, we work with each person. They're all different, but how can we get the cost as low as possible, focus on maximizing the cash, and get your compound interest curve going as fast as possible?
100%. I'm going to ask you a question they might not understand, but we can break it down. IUL or straight whole? What's your preference?
Oh, good question. That's probably one of the number one questions I get. IUL stands for Indexed Universal Life, and then whole life is just whole life. They are both life insurance, but they are built on 2 different chassis. Okay. Whole life is the granddaddy of all insurance. Like, it's been around for over 100 years. It is built all based off of guarantees. So when we're talking about these different policies, we're mostly focusing on the cash value, but I'll kind of define the differences here in a minute. So whole life is all built on guarantees. IUL was introduced back in I want to say it was like the 80s. But IUL is based off of your cash value. Instead of it receiving guaranteed interest and dividends, your cash value is tied to the market in some capacity. Usually it's the S&P 500. Now, the index part comes in, they'll give you a floor of 0, 1%, something like that. So you'll never earn less than 0 or 1%, but we all know the market's going to drop sometimes. If that company is eating your losses, they're also going to eat some of your gains. So they'll give you a floor, and then there's a ceiling on what you can earn, and your cash value functions within that index. So the whole premise is, I can invest with safety and security inside of a life insurance policy, which is true. But when we talk about pure infinite banking policies are built on a whole life chassis. We are using whole life insurance policies. That is the purest way to do that, because I want to emphasize this is infinite banking. It's not infinite investing. If you're putting your money into a life insurance policy to get the best rate of return ever, you're doing it wrong, right? Like, your investments and your real estate or your business, that is your investment. That is your rate of return, okay? That's, for example, that's your hammer. Your infinite banking policy is going to be your saw. It's built completely different to serve a different purpose. So that doesn't mean IULs are bad. There's no good or bad tool, just you don't want to cut a piece of wood in half with a hammer kind of thing. IULs, here's the thing. Let me ask you this, Stephen. So when the market's going up and down, when does most buying opportunity tend to present itself in an economic cycle, up or down?
More buying?
Yeah, like when does the best
everyday average people?
Yeah.
As an investor, I'd have a different answer. But as a consumer, most people, when the market's going up, they buy more stuff.
Yeah, that's their typical. But we want to try to buy when it's down, right? Like when the market crashes and prices are low, that's when we really want to, get while the getting's good. Yeah. Here's the thing. If the market's down and these buying opportunities have presented itself, well, if the market's down, that means that your cash value is down as well. And you're going to have to lock in losses to go capitalize on that opportunity. So if you're chasing rate of return, you're missing the point behind the infinite banking concept. Now, have I done IULs? Have I used IULs? Absolutely. We've used them for like key man or buy-sell agreements, right? They serve a purpose, but the number one issue is, one, the market does fluctuate, as can your cash value. You're going to have to lock in losses just to go capitalize on an opportunity. That's number one. Number two, with a whole life policy, you're guaranteed that your policy cost will never go up. You're locked in for life. And the joke is it's good for your whole life, right? So it's locked in. IULs, if you ever look at their illustrations and look at their policy design, they do not have a guaranteed premium. They have what's called a target premium. So they are going to try to hit that target. But if you get older, your cost of insurance go up, actuarial tables change, company performance isn't as expected. If anything outside of the original design were to go astray, they can and will increase your premium. So when you've had this thing for 10, 15, 20 years, oh, hey, by the way, you were originally putting 10,000 in here, but now we need you to put in 15. Now we need you to put in 20, or the entire policy is going to implode. So again, they're not bad tools, but they need to be used accordingly, and they need to be treated as an investment, because that's what they are. They're an investment. They're not a bank account. So can we do them? Absolutely, in the right capacity, but true infinite banking is built on a whole life insurance policy.
100%. I totally agree with you. And for anybody that, maybe has an IUL, or if you're looking into
I had
it.
a VUL, which is, that was,
yikes.
Before I learned what I was doing, VUL is variable, so there's no floor, no ceiling. You're fully exposed to everything. So I really ate the dust on that one.
To your point, I think there's a time and a place for almost everything. But with an IUL specifically, I think the big mistake most people make, it's not even really 15 or 20 years once they've had it and something goes up. It's like 30, 40 years after they get it. Because most people that are getting an IUL, at least from what I found, are usually in the 30 to 45 years old range. Sometimes there's outliers to everything, of course. But, you expect it to be a permanent insurance like a whole life, but because it has the contingencies of market performance, to an extent, of course, not to put myself in a trick bag or anything. The issue is most IULs aren't structured properly because the agent that structures it doesn't know what they're doing. And so then you get to be 80 years old expecting to have a $1.5 million death benefit that you've kept for your whole life. And then your insurance goes up and it's now a $55,000 yearly premium. And because of the way the market performed and everything else, well, now your policy lapses and you have no insurance and you lose it all.
After you pay for it exactly for 30 or 40 years.
And that's why IULs have such a bad rap. So if you're going to get one, I think they're great as an additional investment opportunity, as a safe place if it's structured properly. Yeah. Not to be the type of thing that you're going to go out and you're going to expect a 3, a 4, a 5, or a 10x on your money, right? Like that's what we're doing real estate for. That's what we're doing these other investments for. So straight whole life makes a lot of sense. There's some other concepts that I'm sure Erica you might share on. Like I'll give an example. With the insurance space, one of the things you have to be careful to do is not turn your policy into a modified endowment contract, otherwise referred to as a MEC. So for somebody that is looking into this and is wanting to avoid that, instead of just getting a regular whole life policy that maybe has a $250,000 death benefit and their agent's like, oh man, like it's going to have a cash value and, it'll grow a guaranteed 4% because that's what this company is going to pay out. And, by the time you're 70 years old, man, you're going to have 150,000 cash value. Like What allows them to actually dump 10, 20, 30,000 bucks a month into it, keeping the actual death benefit as low as possible to raise the cash value as much as possible without it becoming a mech?
Yeah, good question. So the fun thing about that is these policies were not originally designed that way. Used to, back in the 70s and 80s, people, especially like, wealthy people who understood this, were dumping hundreds of millions of dollars of cash into these policies because they understood the tax benefits and the asset protection and all of the things about these policies that are great. They saw that and they're like, holy crap, they're buying itty bitty policies and then dumping loads of cash into these policies. Well, guess what? Uncle Sam caught wind of that and realized how much he was losing on all of those tax benefits people were getting. Hey, if it goes from one way, it's taken from another. So that's when Uncle Sam stepped in 1988, and that's when they instituted the modified endowment contract rule, which is a ridiculously complicated algorithm. Basically, that was the IRS's way of saying, hey, you can use this policy and you can put cash into it, get all the benefits, but you can only do this much, right? You can only take this much benefit. So if the IRS tells you you can do something, you can take this benefit, but only this much, how much of that benefit do you think you should take?
All of it.
All of it, right? We want to take the full advantage. So with that, it is a complicated algorithm that is based off of how much death benefit and premium you have. That's going to determine how much cash value you can put in. So the higher your death benefit and the more your minimum, which is your base premium, the higher your minimum, the higher your maximum, right? So with that being said, how do we take advantage of this tax code? What we're going to do is we want to have a unique blend of a whole life policy, and then we're going to add a term rider. So it doesn't necessarily lower your death benefit, but you can get more death benefit for less cost, right? Because term insurance, as we know, is like dirt cheap. So it's a really easy way to increase your death benefit without increasing your premium a whole lot. Now, for those of you, I know what you're thinking. Well, I want to get like no whole life and I want to get all term. There is, kind of going back to my nerdy statistics days, there's a bell curve, right? So there's a point where it's efficient and then it's going to cap out where if you put on more term insurance, it creates more cost than it does create benefit. So if you do too much term, you start to lose benefit. But there is a point where if you add on term, put a term rider onto your whole life. So it's all one. So I'll give an example. So Stephen, your point earlier, if you have a $250,000 whole life policy, I'm just going to start throwing numbers out there. Let's say you're putting in $7,000 a year. Well, and that's all whole life. You might be able to put in 8 or 9,000, maybe 10,000 of cash or so. But let's say you have a $250,000 whole life and then you add 250,000 in term. Well, now only being able to put in 8 or 9, now you can put in like maybe 15, 16, 18, right? So because you've increased the amount of death benefit and you've increased your premium, now the IRS is like, hey, there's a lot more death benefit here. So sure, now you can put additional cash in. Now a MEC is not the end of the world. All the MEC means is that you lose the ability to take your money out on a tax-free basis. So you lose the ability to take out those loans and the cash all tax-free. The death benefit still pays out tax-free, but we usually only see somebody intentionally make a policy for like estate planning purposes. Like, hey, I'm going to dump a whole bunch of cash in this policy. I don't want to touch it. But when I die, my family's going to receive this inheritance, tax-free, estate, income, estate tax, no probate, no nothing. So it's a great estate planning or generational wealth tool. But if you're using it for funding real estate or buying a business, we want to avoid the MEC if we can.
100%. Because ultimately, I'm gonna give this analogy for folks. I know you're an analogy gal. You'll like this. Life insurance, to an extent, is like the armored truck of your financial plan, right? It's not the race car and it's not the airplane, but it is the armored truck. Because every vehicle has a different purpose. It's the place where you're going to put it. It's safe. It's not going to go fast, but it's going to go far. And then those other vehicles through real estate and everything else, that's where your sports car and your airplane come from.
That is one of the best. Now, I've been doing this a long time, and that's one of the best analogies that I've heard. Yes, I love that. And so it's funny that you say armored car. I actually refer to them as the vault, right? Armored car is probably a little bit better because it relates to the speed. But if you think of a vault in your safe, in your closet, or, wherever you keep your vault, right? You don't have to tell us, but think about it. You can put money in when you want. You can take money out when you want. It's secure. It's protected. But Stephen, who knows how much cash is sitting inside your safe or your vault at home?
Only me.
Just you. It's nobody else's business. So if
Right.
you have creditors breathing down your neck because maybe a property or a business didn't do too great, or you get, God forbid, get sued. This is a very litigious society. So if you have a clumsy tenant or an angry investor, right? Like, they're coming down after you going on a lawsuit. Nobody knows how much cash is in there. So
Right.
it's just a great, armored truck is a great example. It's secure and it's private. It's not going to go fast. Oh, and I want to come back to that real quick because you mentioned these whole life policies. If you walk down the street and you go visit your State Farm agent on the corner, which, nothing against State Farm. I'm just using those as an example.
I have everything
but you say, hey,
against
I want
State
to,
Farm.
I know.
Their
But
property
if you
and
go down
casualty
to your
side is
local insurance
trash.
agent and you say, I want to put money into an insurance policy, they're going to take whatever you're putting in and put it all towards base premium, which means
Okay.
you're not going to have year 1, no cash. Year 2, no cash. Year 3, no cash. Maybe year 4 or 5, you might have a little bit, but it's going to take like 10 or 12 years for this thing to break even. And that's why a lot of people are like, oh, this sucks. Well, they serve a purpose long term, but it's not great for, warehousing cash for investment purposes. So when we look at infinite banking, it has to be structured in a way that we get your premium dropped and get more cash than premium in there and maximize that MEC limit. So coming back to your point, people who are familiar with these policies that think they take a long time, only if they're not structured correctly. It needs to be designed and set up in a way that you can maximize cash, but you also want to get the long-term benefits of the dividend and the growth as well. So there's a unique blend that has to occur there.
100%. Well, Erica, thanks so much for spending some time with us today. If people want to connect
Thank
with
you
you
for
for
having me.
more, learn more about what you're working on, where should they go for that?
Good question. So our website is infinityinvestmentstrategies.com. We do have a resource library that is free. So we have, I've written, I don't even know how many articles, multiple articles and little white papers on different topics that relate to infinite banking. I am in the process of recording videos that will complement those as well. So there's a free resource library on there. You can also find our contact information on there as well. All of my socials are at the Erica Neal, and you can find me across the board there. So I'd love to connect and answer questions.
There you go, folks. Go drop her a follow from the Fuel Fam, the Real Estate Pros podcast. Show her some love and let her know where you found her. And we'll see you in the next episode. I'm hoping that you get as much value out of this as I did. Erica, thanks again for joining us.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.